we should get started. So welcome everyone. Thank you for joining us for the webinar on internal controls for fraud prevention in manufacturing and distribution. Some housekeeping items. We will be launching poll questions throughout the webinar for CPE tracking. So if you need continuing professional education credits, please be sure to answer those poll questions. You'll need to do so. If you have questions throughout the presentation, please put them in chat. We'll monitor chat and try to get to them as best we can. If your question cannot be addressed during the session, one of us will follow back up with you after the webinar. Presentation slides will be able to be downloaded from the handout sections of the control panel. Also, this webinar is going to be recorded, so if for some reason you have to disconnect or you want to go back and listen to us again, it is recorded. It'll be released on demand here in the next couple days. And at the conclusion of the webinar, a short survey will launch, which you'll also need to complete for the professional credit. CP certificates will be sent via email within 7 days or so. This page is a disclaimer. We're going to tell you a lot of information, and this just protects Sikich, saying we're not telling you what to do. So if you do it and something goes wrong, call us for help. Just don't call us to yell at us. My name is Steve Randall. With me today is Melanie Mui. We'll get into a little bit of our backgrounds here in a second. First, a little bit about Sikich. Sikich is a accounting and advisory firm. We're one of the top, I think, 25 now firms in the U.S. We have over 2,000 employees across the firm, spread out across the U.S. and some parts around the world. We're part of the Prime Global Network, which gives us boots on the ground in, I think, 125 countries or something like that. Our services are what you'd expect from a CPA firm, which, assurance, tax, and wealth management makes up one group of our company. The other group, where Melanie and I sit, is client solutions, and the third group is our fairly large government practice. If you have any questions about Sikich, please reach out to any one of us at any given time. For me, my name is Steve Randall. As I said earlier, I'm a principal within Sikich, and I lead our risk advisory practice. I live in Chicago. I've been with the firm about 2.5 years now. The risk advisory practice includes various internal controls, risk management services, including internal control, internal audit, fraud investigations, fraud prevention, cybersecurity, SOC 1 and SOC 2 examinations. This allows me to work with very talented people like Melanie while serving and advising phenomenal organizations and the people they employ. That QR code in the upper right-hand corner is my LinkedIn profile. So if you have your phone handy, take a picture of it. It'll take you to my profile. If you click connect, I will click accept, and we'll get connected. As you see, I've been doing this a long time. First 10 years or so of my career was spent in operations in financial services, and then I've been in internal audit now for the better part of 25 years. Melanie.
Hi everyone, it's great to be here with all of you today. My name is Melanie Mui, and I'm a director within the Sikich GRC internal audit practice. Before I forget, if you want to scan my QR code, feel free to do so and connect with me on LinkedIn. I've been with the firm for 2.5 years, and I was born and raised here in Chicago. For the past 20 plus years, I've focused on internal controls, risk management, and internal audit in the government, not-for-profit, manufacturing, and energy sectors. I currently lead the internal controls assessment practice here at Sikich. So I'll turn it back over to Steve now to start with the content you guys are here to learn about.
All right, so we're talking about the importance of an effective system of internal controls, an area often overlooked and sometimes an afterthought, and how those internal controls prevent fraud. I realize it may not be the most glamorous of topics, but it got you here. So Melanie and I will do our best to share some of our knowledge in the most interesting and lighthearted way possible. And while the title emphasizes fraud prevention, internal controls are way more than fraud fighters, and we'll discuss other reasons why they're important and you should be considering them. On the following pages, we're going to discuss um, what can go wrong from ineffective internal controls, your role in internal control design, and your responsibility for verifying the internal control effectiveness. Professional skepticism is the best approach when considering internal controls and the possibility of fraud. It can be summarized in this quote from 45 years ago. Many of you recognize this quote, at least if you're from my generation. It's a quote from Ronald Reagan. He was talking about dealing with the responsibilities as the president. He could just have easily been talking about internal control effectiveness and the ability to prevent fraud. Information is constantly flowing in and out of your company, and you and your colleagues are handling and processing that information on a continual basis. Also, money is constantly flowing in and out of your organization, and similarly, you and your colleagues are processing and accounting for those funds on a regular basis. So the question I want you to consider is, what are you doing to protect and secure the flow of information and the flow of funds? What are the largest transactions you process? How do you make sure they're recorded properly? Are you dealing with cash? How do you make sure it's accounted for properly? Are you making payments? How do you make sure they're routing to the appropriate party? Are you receiving sensitive data? How are you securing it? If the answer is we're good, Steve, because Jim does it, he's always done it, you should consider your procedures. If you spend some time considering what I call corporate defense mechanisms, you'll create a strategic shield that will allow you to focus your attention on what matters most. So here's the agenda for today. We're going to start at a high level and discuss the role of governance and fraud prevention, the importance of risk management, and then we'll go into more granular detail and discuss internal controls and internal control monitoring, common internal controls to prevent fraud, and then the ongoing management of your internal controls. Throughout the presentations, we have interspersed 3 questions. Your answer to these questions are a requirement for getting a full CPE. I'll try to alert you in advance when they're coming up, so if you happen to get distracted, you can hear me and come back to this. But with that, here's the first question. All right, so first question, what interests you most about this webinar? We'll give you a minute or so to make sure you're clicking the response. Okay, we want to close this out. We got 85% of you voted. Looking at the results now, you have a general interest in the topic. You want to better understand internal controls. Well, you've come to the right place. You're concerned about the risk of fraud or a breach. Uh, Only 18% of you, that's good. You need the CPE. Well, I'm glad you're here to get it. Something else, maybe we can dig into that later. Can we close that screen? Thank you. I'm talking to our support in the background, so when I say things that sounds like I'm talking to myself, I'm really talking to our team. Finally, on to agenda topic number 1. Melanie, I'm going to take this. Are you okay with that? All right, let's talk about governance. Your leadership team sets the tone for your company, and it's expected to promote and foster an ethical and responsible culture. Most of you will understand this as tone at the top. Leadership not only has to set the tone by what they say, they have to reinforce the tone by what they do. There are numerous stories about a leader losing his or her job because they crossed an integrity boundary. They weren't walking the talk. And that's obvious to most of us who have ever worked in an organization where leadership says one thing and does another, or maybe says one thing with a wink. Uh, so tone at the top, critical importance. But while it starts at the top, governance is a responsibility that should be shared throughout your company. The head of accounting and finance, whether you call that person a CFO or a controller or a VP of finance, sets the governance for accounting and financial reporting. They play a critical role in identifying and managing financial risks, and specifically fraud risks. They're responsible for establishing robust financial controls and systems to safeguard assets and to mitigate the risk of financial mismanagement or fraud. Employees also play a critical role in effective governance in several important ways: by adhering to high ethical standards, by complying with internal policies and procedures and external regulations. They also have a responsibility and hopefully access to channels for reporting misconduct or unethical behavior. We're going to talk about that in a little bit here. They should avoid situations that oppose obvious conflicts of interests. They have a significant role in shaping the culture and the ethical tone, and they influence stakeholder relationships through their professionalism, responsiveness, and commitment to service. All this to say, the actions and behavior of everyone collectively influences governance practices and your ability to build trust with your stakeholders. Governance expectations should be documented, understood, and shared across your company. Like I said, governance is everyone's responsibility, not just leader, but everyone. You need to ensure socially responsible and ethical behavior. You need to implement appropriate systems and procedures to mitigate risk. You need to ensure the integrity of internal controls, the security and availability of technology and information systems, and the accuracy of financial reporting. You need to ensure disclosure controls and procedures are compliant with all relevant laws and regulations. And you need to ensure compliance with all applicable legal and regulatory requirements. And then lastly, you need to ensure that the principal operating risks are identified and managed. A breakdown in any one of these could spell doom for your company. So let's take care of our governance responsibilities so that when your company makes the news, it's because of the good things you do and the value you create. But if we're only that easy, because sometimes it can seem as if you're Sisyphus pushing a boulder up a never ending hill. You can have the greatest ideas, the biggest ambitions, but if you don't have the resources, it's nearly impossible to execute. And if you're like most places I've worked for or worked with, resources are not unlimited. You likely can't allocate adequate funds to instantly make your vision a reality. People and organizations, the nefarious ones, are constantly trying to bring you down and distract you from your mission. You're likely relying on dated technology, resulting in overly manual processes. And now with AI in play, you have a whole list of new worries. And as far as internal controls go, you probably are great at rallying around a problem, but too many times that problem could have been or should have been avoided if someone would have just done the right thing at the right time. Because we're not in the firefighting business unless you're actually in the firefighting business. But I saw the registration list. I don't think any of us are. Putting out little fires everywhere or one big fire distracts you from your mission. And conducting triage in operations is time consuming, wasting valuable resources that could have been used to supporting your strategic objectives. And even with these challenges, maybe because of them, your role in governance is critical. Because if you don't, the results could be horrendous. You can't afford a 6 or 7 figure wire fraud. Significant wire fraud schemes are hitting the news, uh, unfortunately, quite frequently. They're not slowing down. Um, you can't afford a security breach. Attackers are out there 24/7. And it isn't a matter of if you're targeted, it's a matter of when. And I'm assuming most of you have already experienced some sort of attempt. And you better have great backup and recovery capabilities because you can't afford to be held hostage by ransomware. If you're storing confidential data, you can't afford a leak. You can't afford to be shut down because of a disaster or accident. You can't afford the loss of resources or funds due to mistakes, theft, or fraud. And you can't afford accounting errors to impact uh, your regulatory responsibilities and your financial reporting. But no matter how well intentioned you are, villains are out there trying to undermine your stability. They're dressed in normal clothes, doing normal things until they're not. What's showing on the screen are recent headlines I pulled from Google. These are impacted manufacturers of all shapes and sizes. Some may look familiar to yours. Hopefully none are yours. And unfortunately, these are not the only examples. This slide could have gone on for a long time, but for the sake of time, I limited the list. Now, as you will see, some of these listed are cyber attacks and data breaches. Did you know that numerous studies indicate that human error is behind most data breaches? A malicious actor may instigate, but it's human error that opens the door. And it's not just limited to cyber attacks. Many problems we find and we're asked to investigate are not necessarily fraud or subversive behavior. It's due to human error. But since the slide is mostly about fraud, I have some additional information that you may find interesting. This is from the Association of Certified Fraud Examiners and their 2024 report to the nation. The ACFE, the Association of Certified Fraud Examiners, is a separate independent party with absolutely zero affiliation to Sikich. So I share this as an independent, unbiased data point. The report to the nation shows facts and figures from annual studies on fraud. They collect all fraud cases they can find and they dig into them on an annual basis. The first slide here shows how companies typically find out about a fraud. When a fraud occurs, I often hear the question, hey, where were the auditors? The auditors only catch 3% of frauds. If you look on the slide, it's way down there near the bottom. Melanie and I will touch on this later, but it simply isn't the auditor's job to catch fraud in your business. And as you can see here, obviously, the most frauds are identified via tip. So if I were you, the question I'd be asking myself is, do we have a hotline and is it communicated? Any fraud that is identified through a tip, through all the cases they've studied in 2024, that fraud usually runs for 12 months before the tip comes in. And that 155,000 is the median loss across all of those frauds. The loss is actual dollars stolen and doesn't include costs for investigation, legal fees, prosecution, reputation and damage and such. So the true cost is significantly higher than that 155,000. I assume most of you on the webinar work for a company that does not have an internal audit function. I think there's like 5% of you that registered that come from an internal audit background. So that's the vast majority, I think, does not have an internal audit function. So if you do not have a hotline and you do not have any internal audit department, you're placing your fraud detection eggs in the management review basket. So again, I'd ask yourself, how thorough is your management review process? Hopefully this gives you something to think about. Some more information from the report to the nation. 21% of all fraud happens to organizations with less than 100 employees. Medium cost of 141,000. The chart shows a breakdown by company size. I'll give you a second to review. This information, however, is free from the ACFE website. The report to the nation is probably a 60-page report. You can read it, download it, look at all the great pictures and graphs. You may be thinking as you're looking at Steve, my team's worked together for a really long time. It absolutely can't happen to us. Come on. Well, here's another slide, more information from them. More than half of all perpetrators of fraud work for an organization for at least 6 years. That employee who does everything for you and has worked with you for a long time and is trusted. It can happen anywhere by anyone. It's good to trust. It's a building block of a solid relationship, but it doesn't absolve you of the responsibility to periodically verify. This is another informative graphic. Fraud falls into 3 primary buckets: corruption, asset misappropriation, and financial statement fraud. More importantly, this shows the massive number of fraud schemes that exist. And if you look at the quantity of fraud cases per category, it's consistent with the number of schemes. Asset misappropriation happens most frequently, but it's often combined with a corruption scheme. 82% of organizations modified their internal controls or their corporate defense mechanisms after the fraud. And interestingly, 95% of the new internal controls were evaluated to be effective. So here's the question: why wait until a fraud? Well, let's implement those effective internal controls now and not wait until something bad happens. And it's not just fraud. Obviously, this is from the ACFE, so this is information about fraud, but I've already talked about mistakes, unintentional errors. Internal controls can prevent or at a minimum detect when mistakes happen. So let's not wait until it's too late to get those controls implemented. And on page 6 of the the ACFE report, the emphasis is on how to make an impact. One of the primary strategies is to sell the idea of a fraud prevention to your management team. It's one way to certainly safeguard your assets. We're still on the overall topic of governance, and governance is way more than just looking out for the fraud monster. As we know, people make mistakes in terms of financial reporting. You know the words significant deficiency and material weakness. In a world where trust and reliability are crucial for ensuring stakeholder confidence, what are you doing to protect that trust? When everything is running smoothly, it can be hard to consider a plan for things going wrong. Bad things can happen anytime, anywhere. And as I keep mentioning, most of the problems we observe are not perpetrated by someone acting maliciously. On the contrary, it's a good employee, a loyal employee, a faithful employee, someone trying to do the right thing for your organization, but they just make a mistake. Sometimes it's a minor mistake, sometimes it's a massive mistake, but it's still just a mistake. And everyone makes them. The busier we get, the more stress we're under, the more likely we are to make them. We need to have mechanisms in place to stop these errors, what I earlier referred to as corporate defense mechanisms. And we need to independently review these mechanisms and make sure they're effective. Obviously, mechanisms equal internal controls. So let's put a bow on this governance topic. Similar to a lot of things in life, it starts with us as individuals. Obviously, when working in the M&D sector, there's a significant amount of responsibility. As I mentioned, nobody wants to end up in the news. All of you are held to the highest ethical standards. For governance and enterprise risk management strategies to work, you as individuals must be part of that. Otherwise, they won't be effective. And earlier, I said I'd alert you when a polling question is coming up. Well, it's coming up. Can we launch that question? How concerned are you about the likelihood of a breach, fraud, compliance violation, or other risk to your organization? Thank you. So we're equally weighted, not concerned, extremely concerned, moderately and slightly. Okay, that makes sense. Melanie, anything jump out to you about these stats?
Nope, they look pretty good to me.
Yeah, it's a typical bell curve. It's what we see.
Mhm.
Moderately concerned, extremely concerned. It's I would highly recommend taking at least uh, at least a quick glance at your system of internal controls and how well you think they're operating. We're going to talk about some internal controls that you should have in place here in a minute. Thank you. Thank you for responding. All right, Melanie, over to you.
All right, so on the slide says the importance of risk management. So risk management is essential because it helps organizations and individuals anticipate, understand, and mitigate potential issues that could harm their objectives, finances, reputation, and even operations. All organizations, no matter the size or industry, should have risk management strategies. Some are informal and some are more developed than others. Risk management is crucial in preventing losses and reducing costs, enhancing decision-making, and ensuring legal compliance. Ultimately, it builds a foundation for long-term stability, performance, and success by proactively addressing uncertainties before they become critical issues. Next slide. Now, as we go through this today, the questions we want you to be thinking about are, what are your risk management strategies? And not only if those strategies can identify and mitigate risks, but are those strategies designed and operating effectively? If your risk assessment is solely based on a feeling or based on your trust in the individuals performing the tasks, there are plenty of stories where that trust has broken or even failed. So you may want to consider testing those strategies to ensure they are appropriate and operating as intended. If you don't have any form of risk management strategies, what can happen? Well, fraud. Steve showed the slide of various headlines of real-life frauds that have recently taken place. Fraud happens at both large and small organizations. If you do have formal risk management strategies, that's great. You're effectively improving your chances of identifying risks to your company. And when you identify those risks, you can better effectively mitigate them. Now, most companies employ the 3 lines of defense model, which we'll go through on the next few slides. The 3 lines of defense model facilitates strong governance and risk management, where all the roles within the 3 lines are working together collectively to contribute to the creation and protection of value, which is a win-win for everyone. Depending on the size, complexity, and staffing of your company, you may have stronger first lines of defense and less so on the second and third lines. Or perhaps in smaller companies, the first and second lines are performed by people wearing multiple hats with multiple responsibilities, and there is very little difference between the first and second lines. We'll go through these slides, we'll go through these lines of defense in more detail in the coming slides. But as you can see on this slide, the first line manages day-to-day operations. It also designs and implements the internal controls. The second line provides expertise and support such as risk oversight and compliance, as well as monitoring and reporting. Lastly, the third line is independent from management and promotes and facilitates continuous improvement, such as evaluating controls and risk management effectiveness. Now, the first line of defense is your employees and what they're doing in their day-to-day jobs. Hopefully, they're following established and documented policies and procedures. Policies and procedures, whether defined or informal, preferably defined, help guide employees in their jobs and how they're supposed to perform their tasks. Included within these policies and procedures should be internal controls. When internal controls are designed and operating effectively, they help protect the company. If there are weaknesses or cracks in the first line of defense, which this line is truly foundational, it becomes harder to identify issues. So there's an increased chance of fraud and risks you're not aware of coming to the surface and causing a bigger problem than there needs to be.
Hey, Melanie.
Yes, sir.
Sorry for interrupting. As we're going through this, I'm just thinking for fraud prevention, what's the number one control I should have, right? And often when we go in and do an investigation, it's because, well, not because, but policies and procedures have not been reviewed in such a long time. And it really provides an updated policy and an updated procedures, the roadmap that your employees follow to execute their job. And as you said, it embeds internal controls. So if there's only one thing you do coming away from this, it's take a look at your policies and procedures and make sure they're updated, and make sure that your employees are following them. It's not just great for fraud prevention. It's great for making sure things are done accurately, done the way you want them, and then it allows for easier transition when there's employee turnover. Carry on.
All right. So we'll move back on. Let's see. Segregation of duties is the most important control to have in place, especially in the first line. This means you shouldn't have one person having too much opportunity and authority, allowing them to perpetrate a fraud. The more you're able to segregate duties, the more it allows for better protection of the company. Many companies we work with struggle with segregation of duties due to the fact that they simply don't have enough staff. However, there are a number of risk mitigation strategies that should be implemented with smaller staff. So your organization can help the first line of defense do their jobs effectively with 1, job descriptions that include specific roles and responsibilities. 2, like Steve said, policies that are formal rules or guidelines that explain the organization's standards that must be followed. Excuse me. An example is a policy requiring that bank reconciliations are performed monthly. 3, procedures that are step-by-step instructions on how to perform a specific task. Building off that last example, it could be the steps on how the staff accountant performs a reconciliation. And 4, internal controls, which we'll discuss on the next slide, but an example of that would be having the accounting manager review the account reconciliation performed by the staff accountant. Now, the Institute of Internal Auditors is the governing body for the internal audit profession. They set the standards all internal auditors should conform to. Their definition of a control states, a control is any action taken by management, the board, and other parties to manage risk and increase the likelihood that established objectives and goals will be achieved. Internal controls are basically policies and procedures implemented by a company to ensure their financial reports are reliable, operations are efficient, and activities are compliant with applicable laws and regulations. Internal controls are essential to good governance. They should be documented in procedures, understood by employees, and reviewed by management and leadership. Also, they should be tested to ensure they are effective. We talked a little bit about testing, but we'll talk more about the importance of testing internal controls in later slides. So the second line of defense, as discussed earlier, could be the same individuals as the first line of defense. This might be the case for lean companies. For other companies, there might be separate functions or groups. Whether you have a full enterprise risk management group or you just sit regularly with your team to discuss risks and how to mitigate them, it doesn't matter. The important thing is that it's being done. Meeting to discuss what risks you should be considering in the coming year and how you should address them is a mitigation strategy that can be applied at smaller organizations. For some, when talking about the second line of defense, it could be an outsourced risk mitigation strategy. Now, identifying, understanding, and then applying a mitigation strategy are the important things. If you're not in the process of identifying risks, you won't be able to determine how to remediate issues or apply a risk mitigation strategy to them. Similar to the first line of defense, if risks are not identified or there are weaknesses in the second line of defense, then the chances of those risks occurring or you being unprepared for unidentified risks increases. Now, as I mentioned earlier, all companies, no matter size or industry, should have risk management strategies. Internal audit's role is to be the third line of defense. For most manufacturing organizations, we find this to be the most neglected line of defense. The third line of defense is independent assurance, and it establishes accountability within the organization. It's important that individuals know someone will be monitoring to ensure that things are done appropriately. When we perform internal audits, or when we are the internal audit function for companies, we conduct risk assessments, look at the design of internal controls, and test the operating effectiveness of those controls. We don't just rely that controls have been implemented and that control owners are performing them. We trust, but we verify through testing. Unfortunately, most smaller organizations do not have a third line of defense, and they can benefit greatly from doing periodic internal controls assessments like we do here at Sikich for our clients. We have performed these for several organizations where we go in, we review controls over a wide range of processes, and give our assessment related to the internal controls design and whether they're operating as intended. We also identify control gaps, weaknesses, efficiencies, and redundancies. This gives some assurance to the leadership team and again establishes accountability within the organization. If you don't have a third line of defense, how do you really know that what you've designed is truly functioning properly? And if there's changes in the people, the processes, and or the technology, what happens to the design of the controls? Again, there's a potential risk that controls may not be working, and if no one is monitoring, you may not know until it's too late. Many people assume that the annual financial statement audit will identify all control issues. However, I want to talk a little bit more about what external audit does and does not do. The external auditor's objective is to provide an independent assessment of financial statements for accuracy and compliance with regulations. They focus on financial statements to ensure compliance with accounting standards, regulatory compliance to verify adherence to legal and tax regulations, fraud detection to assess risks as they relate to financial statements, and stakeholder assurance to provide assurance to investors, creditors, and regulators. External auditors focus on financial accuracy and compliance for external reporting, while internal auditors focus on risk management and operational improvements within the company. The external auditors do not evaluate business processes for effectiveness, identify and mitigate internal controls, ensure adherence to company policies, or monitor and prevent fraud internally. When external auditors test internal controls, they're doing so to issue an opinion on the financial statements. In other words, are the financial statements reliable? They are not completing in-depth internal control testing to identify fraud. So now I'll turn it back to Steve to talk more about internal controls.
Yeah, thanks, Melanie. Just want to touch on that. Another piece to that is they're looking, external auditors will, in their work, come to an assessment of if they think you're susceptible to fraud. And if they think that risk is too high, they'll actually potentially walk away from the audit. They'll issue a modified opinion based on that, but they're not doing the deep dive into if there has been a fraud occurred. That's why only 3% of frauds are caught by your external auditor. So don't rely on your external auditor as your third line of defense, I guess is the moral of the story. Okay, so we talked about the importance of them, of internal controls, why they're needed, to make sure things happen as intended. As we said at the opening, Melanie and I are both sitting in Illinois. I actually live down the street from DePaul University. One of the accounting professors at DePaul is a woman who's named Kelly Richmond Pope. Kelly has written a book and actually written a couple books, but produced a documentary called All the Queen Sources. You may have heard of it, but look it up if you've not heard of it. It's called All the Queen Sources. It's the story of a small town of Dixon, Illinois, which also happens coincidentally be the birthplace of Ronald Reagan, the trust but verify guy. Anyway, Dixon was the victim of the largest municipal fraud in the U.S. history. The person who perpetrated the fraud was a long-standing and trusted employee. Going back to the ACFE report, she'd been with the city for a really long time. And the tip came in, it was really by mistake. So that low percent of identifying fraud was a soft-spoken, loyal employee who simply asked one question. The perpetrator, her name was Rita Crundwell. She was sentenced to a whole bunch of years in prison, ordered to pay restitution. In December of this year, her sentence was commuted 5 years early. So if you, that was unfortunate to me. I posted on LinkedIn how I thought that was not the right decision to make. But if you watch the documentary, which is here, All the Queen Sources, you'll be as shocked as I was when the sentence was commuted. In All the Queen Sources for those who are interested. I think it's on Amazon Prime, maybe. or maybe Netflix. So it's easy to find. All right, we got 20 minutes left, which we should give you a chance to ask questions. So I'll try to go through this information quickly, but emphasizing where the important pieces are. So far we explained the importance of governance and responsibility that's shared across your company. We showed some scary things can happen in the absence of internal controls. Melanie explained the 3 lines of defense and introduced the importance of testing internal controls. I thought it would be important to talk a little about an internal audit. Like I said, there's probably 5% of you who are actually in internal audit on this call. Many large organizations have made the investment into internal audit function, whether they've hired that internally or outsourced to a firm like Sikich. A few of the people on this call actually have an internal audit department, a risk management function, and a compliance function, in addition to operations. Internal audit's the 3rd line of defense for organizations that have it. And for those of you that don't have it, it gets a little blurry and sometimes resides someplace else. I ask you to take a minute and think about your company. What's your top risk? How much time, how much money, how many resources do you invest in mitigating that risk? Has anyone independently evaluated the risk mitigation procedures? And if not, why not? Remember, trust but verify. Verify doesn't demonstrate distrust in management. It demonstrates to your stakeholders, to your employees, that you take the responsibility for safeguarding your company very serious. With that, here's your warning that a polling question is forthcoming. So put your coffee cup down and get ready. We launch the question. It's like watching a horse race for me, seeing these bars change and the answers change. I'm really pulling for extremely confident. We're at 85%. You want to close the poll? So 70% of you are either slightly confident or uncertain. Echoing what I said earlier, it's time to take a dive into how effective your internal control environment. Because if you're confident in your internal control environment, that confidence will go away sky high. And if you come back and you find there's some sort of deficiency, you can fix it and then gain confidence. Melanie, anything to add on that?
I think we're good to go.
Okay. Now we're going to share some examples of internal controls. Oftentimes we get called by a client after something goes awry, so we can assist with triage, essentially picking up the pieces after something bad happens and figuring out root causes. Other times we're asked to proactively help so that things don't break in the first place, which is what I recommend all of you to do. These are those stories. The goal is to have you learn and apply these lessons to your company.
Great. Now we're going to go over some common controls that help to prevent fraud. So one of the best ways to protect your organization is also one of the most common deficiencies that we see, which is segregation of duties. One single person should not have complete access to a process without another person being involved. And this is very important for all companies, no matter the size. We can't emphasize this enough. Some examples of conflicting duties are the same person being responsible for both preparing customer bills and collecting payments. The person who handles billing could potentially manipulate customer accounts or misappropriate funds without detection. Or the person responsible for recording transactions in the accounting system also reconciles the bank statements. This lack of segregation of duties means there's less oversight, and errors or irregularities in recording transactions may go unnoticed. Segregation of duties can be difficult to achieve in smaller organizations, but we've helped countless organizations with this challenge. Now, another common deficiency we see is with account reconciliations. Organizations are hopefully performing reconciliations in a timely manner. This includes investigating aged transactions, large or unusual transactions, and any differences, and then performing independent reviews. Account recs are controls to monitor and detect items that may be indicative of breakdowns in your processes. Now moving on to vendor setup and payments, which is another area we see many deficiencies. You want to ensure these responsibilities are segregated. You never want the person who is inputting vendors into the system also being the person who releases and approves payments. Additionally, make sure to verify vendor changes before implementing them. For example, one of my clients, AP managers, received an email from a longtime vendor requesting a change to their banking information. Now, the AP manager corresponded with that vendor on multiple occasions and felt it was safe to change the banking information. So she proceeded to wire the payment. After multiple failed wire attempts and email exchanges, the $400,000 payment finally went through. We later found out that the vendor's email got hacked and the AP manager was corresponding with the hacker the whole time. Now, had the AP manager just picked up the phone to confirm the change with the vendor, which is a common control, she would have found out the change request was fake.
And that's the
Now, next
example.
up,
Sorry to interrupt, Melanie, but that's the example
yeah,
I referred to earlier, where this scheme is happening all the time, and it still happens. It started first time I heard it was like 10 or 12 years ago, and it's still happening. Um, there needs to be just a slight tweak to policies um, requiring validation of vendor changes. It's something easy to do, but we get busy and we just send the payment.
another issue that's been coming up lately with the whole AI thing going on is that people are using AI to, for example, have a Teams call with their finance manager and saying, hey, I need you to wire $1 million to this company or what have you. And without double checking, it turns out that the person who was using AI was faking, like the CFO, using their image and their voice and requesting this payment to be made. And it turns out it wasn't them at all. It was just a hacker. So that's another thing you guys got to keep in mind now with all the crazy AI scariness that's out there. Okay, so with that, we'll move on to inventory physical counts. They're a critical internal control that directly helps prevent and detect fraud, such as theft, misstatements, or inventory manipulation. When performed correctly and routinely, they ensure that the inventory records match physical reality, minimizing both intentional fraud and unintentional errors. Establishing strong internal controls over inventory scrap is also essential to prevent fraud, theft, and financial misstatements. Scrap often represents material that has value, even if it's unusable for production, making it a common target for theft or manipulation. Ensure you have formal scrap reporting procedures, that they are physically segregated from other inventory, and only designated personnel can approve items for scrap. Okay, so next up are production controls. With production planning and scheduling, you want to make sure to use standardized production schedules to plan output based on demand forecasts and capacity. You should require managerial approval for changes to the production plan. And ensure your systems flag deviations from planned versus actual production. With work orders, make sure to use pre-numbered authorized work orders to initiate production jobs. Ensure each order includes details such as quantities to produce, materials to use, and labor estimates. For material issuance, raw materials should be issued to production only against approved work orders. You'll want to track materials, you'll want to track material usage with bills of materials and reconcile actual to standard. You should be recording material movements in real time using ERP or MRP systems. And lastly, perform variance analyses on a month-to-month and year-over-year basis. Next on the list are receiving and shipping controls. Independent verification involves comparing goods actually received to the original purchase order by someone not involved in purchasing or accounts payable. When using receiving reports, you'll want to confirm that goods received match the PO with an independent verification to prevent unauthorized or fraudulent deliveries. You should also perform pre-shipment quality checks to ensure that only products that meet quality standards are shipped to customers, thereby reducing returns, complaints, and damage to reputation. Last on our list, but definitely not all-encompassing, are compliance and safety controls. OSHA and environmental compliance monitoring as a control prevents falsification of safety records. With routine audits and third-party inspections, it reduces the risk that staff will falsify injury logs, near-miss reports, or inspection checklists to hide safety issues or avoid penalties. For safety training, using digital training logs within a learning management system with user logins, time-stamped completions, and auto-tracking can prevent false entries, faked attendance, or backdated certifications. Using incident reporting systems, you can create a transparent, documented process for reporting workplace incidents or near misses to deter concealment or manipulation. Having documented standard operating procedures, or SOPs, for all major operations eliminate ambiguity by outlining the exact steps to follow and reduces the risk of employees intentionally bypassing controls or claiming ignorance. So with that, I'll pass it back over to Steve to discuss the ongoing management and monitoring of internal controls.
Okay, I'm keeping an eye on time as well. I think a couple of questions came in. Um, is it a good time to answer those, or you want me to wrap it up? I can't see them because I'm doing the sharing. I see the windows come up that a question was asked.
Why don't you keep going for now and I'll look at the
Okay.
chat.
Okay. All right. Good. I was on a call, I think it was 2 weeks ago, with a higher ed, privately held higher ed. I know, obviously not manufacturing, but it's a trade school. They have a series of, or a variety of schools that they're managing. It was the operations manager, and she was self-disclosing that she has massive segregation of duties challenges, where she's the one that is receiving invoices, approving invoices, sending payment to invoices, and doing the monthly reconciliation. So she's like, I realize there's a massive problem here, but you know what? I'm the one doing it, so I'm not concerned. But she did want to have us come in and help create policies and procedures to help mitigate that risk and find some way to segregate her duties. She might have been fine with that, but I'm not sure the owner, if the owner knew, and the owner would have been fine with the way she's running the business. So I think we're going to go in and help them write some policies and procedures. So ongoing management of your internal controls. So what can you do? I talked about corporate defense mechanisms. You should set out to do the things that will make your company more stable. Set a strong tone at the top that motivates and encourages employees to be responsible and ethical. Determine what the highest risks you face. Make sure you mitigate the highest risk first. Take a look at your line of defense and how you divide that responsibility for risk management. I already mentioned earlier to dust off and evaluate your policies and procedures, update them as needed, and share them across your company. If you don't have them, create them, and don't be afraid to ask for help if you need it. We're helping organizations all the time write their policies and procedures, help them document internal controls. And speaking of documenting internal controls, don't forget about the third line of defense. Periodically review your internal controls and the design of those internal controls by completing an internal controls assessment. Melanie talked about what that is. It's an evaluation of the internal control design and operating effectiveness over the items that Melanie talked about and the items listed here. Really, you want to be able to discuss with management and your board how effective you are at safeguarding your assets and preventing fraud. We do walkthroughs of each areas. We document what the internal controls are. We identify where there's gaps in internal controls, make recommendations to enhance that system of internal controls, and then test their effectiveness. Summarize it in a pretty little report that then becomes a punch list for management actions going forward that gives items that can be knocked out periodically. If you don't have us do it internally. Have another party come in and do an independent review of your internal controls. If you have an internal audit department, ask them to come in and help you look at what you think your highest risk area. They're eager and willing to help. Here's the links to the QR codes of our LinkedIn profile. Melanie, how are we doing on those questions? Was there anything that we should be answering?
Yeah, one came through and it says, in the tariff landscape, what are some critical internal controls to have in place with the risks of materials increasing? So for this one, I would probably say that you want to make sure that you guys have an approved vendor list. So using only vetted and approved suppliers based on the quality and the reliability and the pricing. Another thing you guys can probably do is like price benchmarking, making sure you regularly compare supplier prices to market rates, to ensure the competitiveness. Another big one would be, let's see, just-in-time monitoring. So you want to adjust your inventory strategies to balance the carrying costs and the risk of price increases. And then making sure that you guys are doing cycle counts and reconciliations, so frequently count the inventory to detect any kind of discrepancies that you guys might have. Steve, can you think of others?
I'm just thinking that 90-day window is about to close. Maybe we'll have negotiated deals where this tariff thing just goes away.
Here's hoping.
No, I think that's good. Every organization, every company is different, and what you're ordering, how you're ordering it, who your vendors are. Third-party risk management is usually a pretty high risk for companies. Supply chain risk management is typically a pretty high risk for companies. So, um, starting with policies and procedures and working your way down. All right, we are bumping up on the end of time here. We're at the top of the hour. As a reminder, please complete the survey that pops up after the webinar is over in order to receive the CPE credits. Certificates, as I said, will be sent within 7 business days. If you have questions that you have, hit us up, either LinkedIn, send us emails, go to the general Sikich email. Today's webinar was recorded and will be available for on-demand access in case you want to share it. One of the cool things with on-demand, you can speed up the playback speed and hear us talk in much faster than we already do. That's what I usually do. And with that, I thank you for attending, and I hope you have a great day. Please feel free to contact us if you need anything.
Thank you, everyone.